FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 8/5/19 on with John Rubino. If you've been watching the action in precious metals for the past 2 days, I mean, obviously, you probably been watching it much longer than that, but just the past 2 days, you didn't have to watch anything else. Well, right now, market's going to close soon in about a half hour. Gold up $23.80 the ounce, silver up 19 cents. Gold's the big performer, widening this gold to silver ratio. Keep an eye on that, but we're looking at $1,464 gold, silver $16.38, Dow down 767 points, US dollar down, believe it or not, 0.54 on the Dixie index. Copper has been getting slaughtered, 256, down all day. Last week, palladium lost $100 in a day. Today, it popped back $10. Platinum starting to move. Well, I guess all these metals, what's going to move them, what's going to make them go is investor sentiment, investor demand. And hey, make sure you go check out John's site, dollarcollapse.com. So we're talking about all those issues. It all comes down to the Fed. John, was the Fed just too cute here, too clever by half, and they're getting burned for it now?
Hey, Kerry, last week the Fed thought they were in control of the markets. Turned out to be the opposite. They were forced into raising interest rates kind of against their will, and raised one time, 1/4 point, and then said, that's probably it. This was just a mid-course correction. That was their term. And the market said, no. That's not the only interest rate cut you're going to do this year, or we're just going to collapse, and that's kind of what happened today. The stock market was down almost 1,000 points on the Dow at one point today, and then it ended up down 700 and some points, so close to 3%, pretty much across the board. That's a huge move.
Correct.
And no doubt it's sending the message that the financial markets want to send to the Fed, which is that you either got to keep cutting interest rates and you have to do away with this quantitative tightening thing, go back to quantitative easing, and you need to do a bunch of other stuff that we'll let you know later. Or the global financial system is going to totally collapse. And so the Fed is going to have to do what the markets tell it going forward, or the guys at the Fed have to be the people who preside over the next Great Depression. That's really the only two questions here. And it's pretty clear that based on the behavior of the Fed and the other central banks, that they're going to ease. They're beginning pretty soon going to start cutting interest rates, and they're going to have to push interest rates down into zero territory. And then we'll see, then the real experiment begins, because we don't know if that's even possible on a sustained basis. A few countries have done it. There's a lot of negative interest rate debt out there, and it hasn't blown up Europe or Japan yet, but the experiment is still pretty young, right? We don't know how this evolves over time. And now with the U.S. pretty much having to join that party, the experiment gets a lot more intense. So it's clear that the next stage of the experiment is going to start having to happen pretty soon. And it's clear that gold likes that. Gold and silver have been doing really well lately, and the mining stocks have been rocking because they're the safe havens in this kind of an environment. It used to be that owning physical gold meant a big opportunity cost because you had to store it, pay a little bit. It didn't earn any interest, so you lost out relative to 6% yielding treasury bonds or whatever. That's not the case anymore. If government debt now has a negative yield, then why in the world would you own, German Bund or a U.S. Treasury or a Japanese government bond when you can own gold and silver, which have been appreciating against fiat currencies ever since the 1970s? In other words, the dollar has been going down relative to gold for as long as most people have been alive. So the odds of that continuing are pretty good. So why would you own those bonds that don't pay you any interest when you can own gold, which is going up versus fiat currencies? That's the calculation that a lot of people are going to make and are making right now.
Yeah.
So this kind of an environment is very good for precious metals, and we ought to expect to see them go up in the future. And we ought to expect to see the mining stocks go up some multiple of what gold and silver go up. Anyhow, that's what happened in the 1970s. It's what happened in the 2000s. And it seems to be what's beginning again. So this is the third leg of the long-term gold bull market that we're seeing starting now.
Yeah. Yeah, well, it's been a long time in coming, John. We've been waiting around for years already. I hate to be a member of the Stop Clock Association, of the International Stop Clock Association, but you know what? It was really bound to happen, and no one should really be surprised by this, should you?
Well, you and I and most of the other gold bug types out there expected it to happen a lot sooner because all the fundamentals were pointing in this direction. We were borrowing way too much money. We were pushing interest rates down to historically bizarre levels. And that's a great environment for sound forms of money. So there's no reason why it shouldn't have started 3 years ago, other than the fact that you can't predict timing. Things don't happen when they're supposed to in life. That's just how it works. But all the fundamentals were in place back then. The U.S. government debt started to accelerate a few years ago, and interest rates fell to just crazy levels in the U.S. and around the world. And central banks were buying up assets everywhere you look. And the only thing that can explain the fact that it took a really long time to happen in the U.S. is that the Fed was the outlier. The Fed was the only central bank that was tightening in any way. Mm-hmm. The other central banks of the world were either continuing to ease or increasing their liquidity injections into the market. And gold, as a result, went up in a lot of other currencies before it went up versus the US dollar. So to us, it seemed like an extension of a bear market. But to people in other countries, gold had already started to enter a bull market a couple of years ago. Yeah. So in that sense, it was kind of an optical illusion for Americans because we were the outliers in that we had a central bank that was tightening. Well, now that's not the case anymore. So we haven't heard from Trump yet, right, in all this, because he's been basically hitching his political fortunes to the stock market. Yeah. And he's been aggressively job-owning the Fed to ease interest rates. Mm-hmm. So now he is probably going to blame the Fed for this in a really public way, which is going to ramp up the pressure on the Fed to do something. And, it's not clear whether it makes them more likely to tighten or at least not cut interest rates because they're not going to appear to be pushed around, or are they going to cave to all this pressure? Uh-huh. And in the next Fed funds meeting, just say, you know what, we're data dependent. The data now says we need dramatically lower interest rates. So here we go. And there's no way to know because you got personalities at work here, and you've got rapidly changing data streams. In other words, the data points that are coming into the Fed are different than they were 3 or 4 months ago. And in general, they're weaker, although there are some stronger numbers, and it's not easy to paint a picture, a coherent picture of where the global economy is right now, because some of the numbers are good and some of them are bad. But I think the general drift is towards slower growth recently. Right. and turmoil in the financial markets, along with the geopolitical stuff that we haven't talked about yet, but should if we have time, point towards weaker growth in the future. And that gives central banks cover to ease, and it gives politicians a talking point when they demand lower interest rates. So it feels like the stage is being set for basically easy money as far as the eye can see. From now on, we liquefy the global economy until liquidity turns out to break the global economy. That day will come. And
no doubt.
It's not clear if that day is here. It's possible that we're already at the end of the part of the process where people trust the central banks of the world and trust the governments of the world. That could be eroding already. We don't know. We won't know until we have hindsight. But when it starts to happen, in other words, when that phase change in people's trust starts, it'll look something like this, with markets tanking and civil unrest in lots of places, and really extreme political positions being staked out by the various major players in most countries, and most people, because of all that, beginning to lose faith in the big systems to keep on taking care of them. So we could be there, and if we're not, we're heading in that direction at an accelerating rate.
Yeah, you just don't know what's going to be. The schedule and all that, but we kind of been saying this was going to happen for a long, long time. Here we are. It's actually happening. And really, at this point, what can really stop it? I don't think anything can. So what about the price of gold here and silver? For years, we've been talking about this, John, for years. Everybody's saying, you don't know what you're talking about. And, they became really disenchanted, really unhappy about the whole thing, and wound up abandoning it, probably just at the time that they should have been embracing it. Because
that's how markets work, though. They tend to go too far in one direction or the other, and they suck people into making decisions at the end of the cycle that they wish they didn't make. And there are a lot of people in equities who've jumped into, say, tech stocks lately, who wish they hadn't done it based on today's action. And with precious metals, this did go on a lot longer than it should have. But the underlying fundamentals were always trending in the right direction. In other words, we were always taking on way too much debt, and we were always creating way too much currency. And we were always creating obligations that would require us to somehow, some way borrow a ton of money in the future, i.e. with pensions and things like that. So those fundamentals were always in place, which means the stage was always being set for a big shift in capital out of financial assets and into real assets, of which gold and silver would be big beneficiaries, but also potentially Bitcoin, which went up $800 today, and farmland, energy assets, things like that. So we've been setting the stage for a long time, and now the shift is kind of sort of starting. You can't say that this is it, but there's definitely a trend in this direction of late. And then we got to see what the Fed does in response to it. And we have to see what the political system does in response to it. If Trump's approval ratings tank because the stock market is tanking and the economy is slowing because stocks are down, that's a very big deal, too, from a monetary policy standpoint, because whoever replaces Trump, if he were to lose this next election, would be at least as profligate and at least as prone to cutting interest rates and aggressive monetary ease in general. So, if we locked in Bernie Sanders or somebody's modern monetary theory policies,
God forbid,
for the next 4 years, because the stock market tanks now and that affects the coming election, that would be a really big deal from the point of view of investing. In other words, you would be even more certain to need real assets in that kind of an environment than you are today. Yeah. So here we go.
Hey, well, one thing I'd like to make clear is we've always agreed the fundamental case for precious metals was there. What wasn't there was the technical case. And now the technical case is clearly there. higher highs, higher lows. We had it breaking the 6-year sideways channel, setting new highs. And we saw just the dollar going up with gold going up. It's not supposed to happen that way, but it was, which shows two things. People still believe in the safe haven status of dollar-denominated assets, and they still believe in gold. So it wasn't really a contradiction. It was just a additional insurance policy. And then looking back, when we look at the number of people holding gold, it's at all-time lows. Funds, banks, etc. Very few of them have any gold. So the least pickup in investment demand from large investors was going to make this thing pop. And we've still got central banks buying gold. So all these things, the technical case really was what was lacking for the past 8 years. Now the technical case is here. Between the technical and the fundamental, I don't think there's anywhere for it to go but up, but not straight up. Hopefully, we don't really want to see a parabolic blow off top, because that makes people lose confidence in the value of assets. So anyway, it's a good thing people, we had our Bitcoin contest, John, a couple of weeks back, because nobody would have been able to guess it here. At this level, nobody would be able to guess it. And I guess we should mention what that price is. And I'm looking it up right this moment, 11,743.70. As it was, the winner, Mike Redlark, which he will be getting his quarters shipped to him tomorrow. I will send them out. He guessed 10,550. So it's 11,743 right now. 10,550. He was less than $12 off from midnight, July 20th. So hats off to Mike. Great job. And John, it's just the beginning.
FSN Radio. It's all about what's next.
Trilogy Metals is a world-class developer in Alaska's Ambler Mining District. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
The Financial Survival Network. It's all about what's next.
The Bitcoin thing is kind of interesting today, Kerry, because gold went up just a little over 1%. It was an okay day for gold, but not a spectacular one. But the junior mining stocks were pretty consistently up 5 or 10% today.
Correct.
Because that's how they behave. They're much more volatile than the underlying metals. And Bitcoin was up 7% today, which means it's behaving, at least recently, like a junior mining stock, which means it's really volatile. Yeah. And if this trend continues, in other words, if global chaos becomes the norm, the dominant theme of the world in the next year, then Bitcoin could have a really nice run, just because it's that kind of an asset. It trades thinly, and a little bit of money flowing in to the upside pushes it way up.
Really goose it up.
Yeah.
I still will have to see if it breaks that 13.5 resistance point. I'm not convinced that Bitcoin really is. I think that Bitcoin buyers will become gold buyers very shortly. That is my gut feel, John. There's a lot similar between them. Even though the millennials are the big Bitcoin buyers and they've never bought a gram of gold in their lives. You've never bought a gram of gold in your life if you're a millennial. Doesn't matter. The point is that people, John, are looking for alternatives, and they're looking for, insurance, right? They're looking to insure the value of their portfolios. You're going to see a global realignment of portfolios, John, where gold, precious metals will pay play a larger role. Analysts, investment counselor types will advise people to up their component to their exposure to precious metals. The problem is they're going to tell them to do it through ETFs. And while that might give a hedge for chaos in the markets and great declines, it doesn't really protect you in the long run. It only protects you partially. You don't hold physical, you don't have the ultimate protection. Not that it's going to be a necessity, but hey, in the last 2-3 months, John, all the losses I had the past 8 years been more than recovered, and I'm way ahead. And I didn't have that many losses, but you're just
I did. But they are coming back.
I got out in 11, and I didn't get back in 16, which I should have, and therefore had a few little bummers laying around from years past, and they just shot up amazingly. So I was the only person I knew who dumped everything in September of 16. I mean, September of 2011. Nobody else did it. So, and not because I'm a genius. I just wanted the money. It's something I could spend it on.
It was really interesting to hear Ray Dalio come out. He's one of the biggest mainstream money managers in the world, and say that today's portfolios ought to have 10% in gold.
Mm-hmm.
And that's a very big deal, because not just because he's very influential, but because he probably illustrates the transition that's going on in the mainstream money management business right now, where they're seeing a lot of their traditional assets be way overvalued by almost any historical valuation measure, and gold and silver being relatively cheap. At the same time, gold and silver are starting to outperform those traditional assets like tech stocks. So if you're a money manager, you notice the action, even if you don't get the thesis.
Yeah. One thing I'd like to say, though, is Martin Armstrong, last time I talked to him, said Dow 35,000. I believe the Dow will continue, because when you look at these negative interest rates, just to give the Swiss government money so that they can give you back less of it in a year or however long it lasts is madness. Nobody is going to go for this in the long run. Yeah, certain institutions don't have a choice. They're captive entities of these central banks. But anybody who can make an investment decision and understand an investment thesis, John's not going to go for this.
Well, it's not a mutually exclusive thing that stocks see inflows and gold and silver see inflows if they're just liquefying everything in sight, right? If they're creating huge amounts of new currency in order to prevent the debt mountain that we've taken on from blowing up on us and taking out the global financial system, then the money that they're creating has to go somewhere. And it's completely reasonable to think that if interest rates are negative, in other words, if a government bond costs you money rather than makes you money, and you look over and see Apple's stock yielding 1.4%, which it does right now, and that's 2% overall better than a treasury bond, then it makes sense. You would choose the global multinational equity over the crappy negative yielding government bonds. So money would flow into stocks. That makes complete sense. But at the same time, you're scared, because of what's happening, and you want some kind of a safe haven asset. So you buy gold and silver, which also have better cash flow characteristics than negative yielding government bonds. So those two things could happen at the same time very easily. And I'm temperamentally a lot more comfortable with something that is down over the past few years, like gold and silver, than with something that has quadrupled in the past 5 years, like a lot of these tech stocks, or that have doubled, like the S&P 500. It's not comfortable to be in things like that, even if there's a reasonable thesis for them going higher. But gold and silver don't have that problem. So it's really easy to invest in them because they're cheap. You can't say that about very many things these days.
Especially silver is cheap, John. I just checked. The gold to silver ratio is still 89 and change. Silver, I don't know what's going to happen. It's going to happen over the next few months. Something will happen that makes silver just zoom. I don't know what it's going to be. Maybe it'll be I talked to some people, John, they think gold could be at 1550 at the end of the year. Talked to somebody else, a very credible analyst. He's thinking could be 1800 by year's end. But something is going to happen that will make silver join the fun even more than it has now. It really hasn't gone up that much. It was at 1470 2.5 months ago. Now it is at 1638.
Boy, Gary, I've been telling my family I would retire and take them to Hawaii if gold hits 2000. I thought it would be a little further along down the road.
Yeah, me too. But there's no resistance.
This is a dilemma. Yeah.
There's no longer any resistance because it broke 1420. According to Peter Hugg, who's a major analyst, gold analyst. More importantly, he works for Kitco, but that's neither here nor there. The guy's been at this for 30 plus years, John. So he's been doing it longer than us, even longer than me anyway. But he's saying that there's no technical resistance after 1420. There's nothing to keep it down. And because, like I said before, the catalyst to this market has been technical by nature, not fundamental, because the fundamental case has been there really since 2000. I think that he's probably right. And once gold really makes a move, silver is going to join it and surpass it. We'll see silver highs. You know, the last high was set, the only commodity, the last high was set over 30 years ago, John.
That is true. That the silver didn't break the 1970 or the 1979 high.
Correct.
In the last cycle, even though it got up there.
It almost hit it. It was within a hair's breadth, 49.20 something. So, it didn't get there.
So we're still looking at a record high price that took place back in the 1970s. Well,
you could
from a fundamental standpoint, the next high is liable to be some multiple of $50 when the time comes. So say gold goes to $10,000 an ounce and the gold silver ratio goes to 50 times.
It could be 500 to 1,000.
That's $200 an ounce for silver.
But we don't even need to worry about it. We don't need to speculate about it. Just to say it could be potentially multiples of where it is now. The other thing is that I was talking to Rick Rule over at Sprott, and he's like an institutional memory sinkhole as well. And he's said, the average bull market in gold shows a 300% increase. Okay. That's actually the short end of it. It's often a lot higher, but the average length of the bull market goes for 3 years. So starting where we are, looking at the intensity and just going out 3 years from a couple of months ago, from say 3 months from May. Okay. Be conservative. Say 3 months from May, kind of when it started really coming together. And we can be looking at May 2022. And, the last 10% time-wise of the rally generally is the largest advance. So that last 2 months of the rally in 2022 could be the most intense part of it, the real blow off. But my gut feel, honestly, we've had an 8-year bear market in metals, probably going to go longer than 3 years. But that is the average. So we can live with that because it's gotten off to such a start. But anyway, I don't want to start saying like we're just saying don't worry about it, just throw your money there. A, we don't give personal financial advice. And B, caution is always the byword. You always have to have a plan how you're going to take advantage. Don't just march idly into this market like lemmings off a cliff, because there's still plenty of ways to lose money. You can buy really substandard quality mining stocks, John, of which we know there's a lot out there, although not nearly as many as there was 8 years ago. And that's one of the benefits of a bear market. It really liquidates the bad investments, the bad deployments of capital, and really enables the ones who are really smart and really well managed to excel. And all you have to do is survive. Survival will get you very far, but you could still lose money in this market by investing in substandard stocks. Don't do it. it's so easy to find the good ones now, John. Superior management, large stake in the company, and superior management means record of success and good jurisdictions with good infrastructure. Although there are some projects that are so overwhelmingly good that the infrastructure is an impediment, but it's not an absolute barrier to developing these projects, especially the way technology is developed now, John. So it's really easier than ever to find those stocks, and the information that's available to you, the investor, is just like nothing before. So be wise, don't get burned. That's really it. Caveat emptor. Just because it has gold or silver in it. Did I ever tell you the first stock I bought, John?
I don't think so.
I never told you this. Well, solar power was big in the 70s, right? There was solar this, solar that. Of course, it wasn't ready for prime time. And there were like 8 companies named solar this or solar that, solar power. And I bought solar power development because I thought, hey, they're in solar power. This is good. Well, these guys were like office supplies. That's what they did. They just named the company in a completely misleading way. And I might have bought it at like 30 cents and it promptly went up to 0. So, you can lose money at this stuff even when the trend is your friend. That's the point. So.
Well, yeah, and just because we're all excited about what's happening right now, Kerry, people shouldn't get the idea that that implies a straight line from here to $10,000 gold. There will be nasty corrections. There always are in bull markets. And this is a really volatile sector, precious metals and the miners. So, it's completely possible that silver goes back below $15 an ounce and gold drops back below 1,000 before it takes off again,
I know what you're saying.
Yeah.
And, what you're saying is, hey, guys, we can be wrong. So don't just take our word for it, and don't mistake our enthusiasm for lack of circumspection and caution. You can be enthusiastic, but you can still be cautious. The two are not mutually exclusive.
Well, Kerry, I'm saying we can be right.
Yeah.
And there can still be a correction that would bankrupt you if you buy a bunch of gold and silver on margin or something like that.
Oh, yeah.
That's part of a bull market. And there can be 30, 40, 50% drops in the price of something on the way up.
Yeah.
So again, the only thing you can really do that makes any intuitive and logical sense with precious metals is dollar cost average.
Yeah, average.
Do not
average
jump
up,
in.
average down. And have a plan. If you're putting your money into precious metals, make it a 6-month plan. Don't have FOMO. Don't have fear of missing out. Even still, if you're at the wrong part of the cycle, that 6 month in will stop you from losing as much, but it won't stop you from losing. But you can still get badly burned even with that. But it's just a prudent thing to do. You don't just dump all your money in after making a short-sighted decision. You just don't do it. And we've seen people do it, John, over and over again. Anyway, we've run over as usual, but there's a lot of stuff to cover, a lot of things going into the market. Just stay tuned because it ain't over yet. It's just getting started. Expect some type of plateauing at some point. It's kept going a lot more than I personally thought, John. I thought it was going to take $100 hit and go back down to the high 1280s. But you know what? Didn't do it. So all the more reason to be cautious because we have had very little respite. We had a $30, $40 respite from the breakout. And it really requires caution because the tree never grows to the sky. Anyway, make sure you check out John's site, dollarcollapse.com. Ours is financialsurvivalnetwork.com. We're going to be doing lots more webcasts in the future, so keep your eyes open. We're also going to be having another contest shortly. So we want you to participate. We'll give you the details. John, till next Monday, let's see what happens.
All right, Kerry. See ya.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.